Hi, everyone. I am Hasira De Silva, and I am the lead analyst for Singapore REITs within Fitch Ratings. Today, I will speak to you about our expectations for Singapore REITs in 2021 and the key challenges they face from a credit perspective. As you can see, the title of today's presentation is "The Challenges Will Persist Next Year." Now, as we know, 2020 has been and continues to be an exceptionally challenging period for Singapore REITs. However, the challenges vary by sector and asset type. For example, hospitality REITs are the most severely impacted, given the weak outlook for international travel, while retail REITs are considerably impacted, although arguably they are less impacted than hospitality REITs. On the other hand, industrial REITs are among the least impacted from the pandemic-led downturn and appear to be doing relatively well. Now, today I will start off by speaking about our global economic outlook for 2021, and then I will go to each of the three sectors, hospitality, retail, and industrial REITs, and outline the key challenges they face. Before I conclude, I will also speak about the role of Perpetual Securities in the current downturn, and also how Fitch treats such instruments in our ratings. Now, firstly, in terms of the global economic outlook, we expect global GDP to rebound in 2021, but there are risks. We currently project GDP growth of a little over 5% in 2021, compared to a contraction of about 4.5% in 2020, which is nearly double the contraction we saw during the height of the global financial crisis in 2009. Our base case for next year's GDP growth assumes that there are no major advanced economies who will implement further nationwide lockdowns in 2021, or that even if they do, the impact of such nationwide lockdowns won't be as severe as what we saw in Q2 of 2020. Now, this is a significant assumption, and we know even at present there are a number of major advanced economies that are contemplating whether to implement nationwide lockdowns. Now, if that happens, and depending on the severity of that impact, our global GDP numbers could be derailed. If we look at expectations for some of the key economic regions, we forecast China to grow a little faster than 7% in 2021 from just under 3% in 2020. We expect the US to return to around 4% growth next year from around a 4.5% dip for 2020. For the US, we think they will reach pre-pandemic economic activity levels by the end of next year. We expect the rebound in the Eurozone, however, to be slower, with pre-pandemic economic activity to be reached only in the end of 2022. In line with the global trajectory, we believe Singapore's GDP will rise by around 6% in 2021 from a contraction of around 6% in 2020. Now, if we go into the individual REIT sectors, starting off with hospitality REITs, we believe hospitality REITs' earnings will remain weak in 2021 on the back of weak international travel. We believe international travel will only return to pre-pandemic levels somewhere in 2024, although there will be some gradual region-specific improvements along the way. Hospitality REITs that are geographically well diversified should therefore see better earnings recovery than others against that backdrop. We expect revenue per average room for hospitality REITs to inch up gradually from the trough we saw for most markets in the second quarter of this year, but it is unlikely to improve meaningfully in the next 6 months. This is because in the absence of international travel, we think there will be high competition for domestic travelers for the existing hotel and service residence properties. In terms of leverage, we think Fitch-rated hospitality REITs will see an improvement in leverage on the back of slight improvements in earnings and also because of acquisitions that they have made in the recent past, which will be more earnings accretive going forward. We think liquidity for rated hospitality REITs will also be sufficient in the next 12 months. Moving on to retail REITs, we believe retail REITs will also continue to face challenges next year, and we think their earnings will be subdued for the next 12 months. Now, we expect foot traffic to pick up in 2021 from the 50 to 60% of pre-pandemic level that we are seeing at the moment. However, we think consumer spending is going to remain fairly weak, and this should keep retail REIT earnings and retail rent pressured in the next 12 months. Now, in this environment, we expect tenant defaults and delinquencies to rise in 2021 and believe that retail REITs may have to continue to support some tenants with rebates, which will again pressure earnings. Suburban malls will, we expect, outperform city center malls, given the suburban malls are underpinned by need-based spending and experiential shopping. However, we note REITs with larger contributions from master leased income, with large retailers and large blue chip tenants, should see earnings impact mitigated to some extent. Now, while master leases itself may require rent rebates if the downturn is prolonged, it is a more second-order impact, and we believe master leases do offer somewhat of a cushion against the current downturn, at least in the short term. In Singapore, we have seen that the government support and rebates that have been rolled out to REITs across the various sectors, in particular the retail sector, has to an extent helped shield earnings decline for Singapore retail REITs compared to some of the other markets. We believe leverage will be better in 2021 compared to 2020, but only because we think earnings will inch up and improve marginally, although challenges will continue. For Fitch-rated retail REITs, we think liquidity is sufficient for the next 12 months and is not a significant risk. I would next go to the industrial REIT sector. Now, as I said earlier, industrial REITs are somewhat less impacted by the current downturn, and is a bit of an outlier in that sense. Particularly REITs that have acquired assets in the recent past will benefit from full-year earnings that are generated in 2021, and this should cushion the decline in some of the underlying existing assets of industrial REITs. We continue to expect industrial rents to remain subdued and vacancies to rise, particularly from properties leased by SME tenants or small and medium enterprise tenants. We think SME tenants' defaults and delinquencies will continue to rise in 2021, and that industrial REITs may have to roll out selectively further rebates going forward over that period. On the other hand, we see e-commerce demand rising, the trend of e-commerce demand rising over the last few years, which will sort of continue over the next 12 months. And e-commerce related units and logistics assets will do well, which should shield the industrial REIT sector to some extent from the underlying weaknesses in, say, the SME sector. We expect leverage will improve for industrial REITs in 2021, again supported by earnings growth from the acquisitions and barring any further debt-funded acquisitions. Liquidity for Fitch-rated industrial REITs will also remain strong. Next, I will go to talking about Perpetual Securities. Now, the reason I thought I'll talk a little about Perpetual Securities is because they have loss-absorbent features that are useful during downturns. And we have seen REITs who have benefited from them in the current environment. For example, Perpetual Securities coupons can be deferred or cancelled, and this offers flexibility in managing cash flows, although we have yet to see a REIT deferring or cancelling a coupon out of the rated portfolio. Now, an interesting point here that I would like to make is while a typical perpetual security, which is MAS compliant, comes with a built-in dividend stopper, which means if they cancel a perpetual security coupon, they will have to also cancel dividends to unit holders, which could have tax implications. But we don't think this by itself will prevent a REIT that is in distress or near distress from cancelling a coupon. This is because, by definition, if the REIT is close to distress, then earnings should be very thin or limited or pretty weak, which should prevent or reduce tax leakage. And therefore, we don't think tax is a significant consideration in such an instance. The other loss-absorbing feature is that perpetual securities can roll over their principal in order to manage cash flows at the relevant call dates. And we have seen some of the Fitch-rated REITs availing themselves of this benefit in the current environment. Now, it's also useful to explain that Fitch, as an agency, typically assigns 100% equity credit, we call it, or we treat the perpetual securities as equity and not debt in the case of the MAS compliant instruments. However, it's also worthwhile noting that we nevertheless include the perpetual coupons as a fixed charge in our fixed charge coverage ratios, because we believe REITs will have to make these payments in all but the most dire circumstances. Now, the other important point in assigning 100% equity credit to perpetual securities is that we expect such REITs to commit to maintaining perpetual securities as a permanent feature in the capital structure. What we mean by this is that when such securities come up for call, we either expect the REIT to roll it over or replace it with common equity or a similar perpetual instrument, but not with senior debt. So in summary, we expect Singapore REITs will continue to face numerous challenges in 2021. The challenges vary by sector and asset type. And in general, we expect some improvements, nevertheless, for each of the sectors going into 2021 compared to the severe headwinds faced by the REITs in 2020. Thank you very much.